Welcome to Fleet Auto News Podcast. I'm Caroline Falls, and today I'm going to speak with California-based Danielle Lackey. Danielle is the Chief Legal Officer at Motus, a software-as-a-service business with a cloud-based platform for mileage, route planning and accounting for personal use of fleet vehicles, among other things. We're going to talk about the US landscape and appetite for transport sustainability. Welcome, Danielle. It's great to have a guest from the US to give us some insights into what's happening in the US fleet world.
Thank you, Caroline. It's a pleasure to be here.
Now, we should probably start with a brief on the company you work in, Motus. What is Motus? Where is it headquartered? And geographically, where does it operate?
Sure. So Motus, as you mentioned, is a software as a service provider. We support companies who have employees who use mixed-use assets for work. So, for example, rather than having a company that owns a physical fleet of cars and owns the physical assets, they have employees that they're reimbursing for the business use of their cars. Or similarly, if they're using their mobile devices, both for personal and for work, we provide the data and the information that they need to know what they should be reimbursing and then to process those reimbursements.
And what is your role at Motus, and maybe how long have you been with them, and what did you do before joining Motus?
Sure. So my role, I'm the Chief Legal Officer here. And so what that means is, I'm obviously responsible for our sort of corporate risk profile and mitigating risk. But because our product is a compliance-based product, because it relates to compliance with employment law, compliance with tax law, and now more recently, compliance with sustainability initiatives, I also advise around our product and provide guidance for our clients to understand how they might leverage our tool to support their compliance programs internally. Before this, I started my career actually as a litigator at a big firm here, and did a variety of different things in the legal space until I found my home here at Motus.
Okay, so you've touched on a few things I'd like to sort of draw out further, particularly sustainability. But first, I was interested to read in a bio of Motus that the automotive data that you capture and analyse across the drivers underpins the IRS or the Internal Revenue Service business mileage standard, like the amount that an individual can deduct for business vehicle expenses. How many fleets or drivers does Motus sort of cover or engage with?
Sure. So our client base is, in the 2,000, above 2,000 clients. And then as far as the number of drivers that's associates to, it's 300,000, a bit over 300,000 drivers.
Okay, wow. So to set the scene for us, let's talk about the US landscape first. The White House has set an ambitious goal of halving economy-wide greenhouse gas emissions by 2030. Can you tell us more about that and how it came about and whether it's in jeopardy at all or a realistic target at this point in time?
Sure. So yeah, the White House, has that goal. I think most importantly in the US is to look across all of the different motivators for companies to reduce greenhouse gas. So while the White House goal might be one, as you know, the Securities and Exchange Commission recently released proposed disclosure rules. We can get into more specifics there. I think that will create a good motivator for businesses. Obviously, we also have, our legal system is interesting in the so the interaction between the states and the federal government. So we have some states that are leaders in the space. California being one, and historically has quite often been a leader. Massachusetts is another in terms of setting goals on banning gas-powered vehicles by a certain date. And then, really importantly here as well is, investor requirements. So companies obviously want to make sure that they're disclosing information about their emissions to the satisfaction of their investors. Also brand. I think the general public is pushing for change in ways that maybe hasn't been the case in the past. And then, finally, we are, as I think is true in many parts of the world, companies are wanting to find the best ways to attract talent and retain talent. And, there are shortages in certain fields. And so this is an area where companies can make change in a way that improves employee morale or improves kind of employee desire to align to the brand and work within that company. So there are, sort of as you might expect in the US, there are government-driven instigators, but there is also a lot of sort of market-driven and individual-driven motivators for change as well.
Yeah, so you've mentioned drivers for building sustainability and environmental credentials. So the appetite there sounds pretty strong. And what are businesses doing at a cracking pace, sort of regardless of government and federal and state goals and regulations?
I think, one thing to look at is I think some people might have the perception that companies are sort of in a wait and see mode, waiting to find out what are the SEC's disclosure rules going to be in final form. Right now, they only require disclosure of scope 1 and 2 emissions and scope 3 only if material. That's something we can talk about as well. But nonetheless, a lot of these companies are already pulling together this information. Like I said, they're being motivated by different types of stakeholders, not necessarily just government. And part of the challenge, I think, for businesses right now is determining how to collect the information that they need, how to know what their greenhouse gas emissions are, who to work with to be able to align to appropriate standards, so that, if they're getting ahead of this and they're starting to do the work, that work is going to easily factor or easily flow into requirements as they come down over time.
Yeah, so as you say, organisations need expertise and guidance to lay out the steps and predict what the future will look like for their organisations, to develop plans that inspire confidence. And how does Motus platform and expertise help companies establish goals or action plans to meet those goals?
Sure. So Motus has historically had a lot of data about our clients' employees who drive that's unique. So if you were to compare, for example, companies that are contracting with consultants to help them determine what their emissions are from the vehicles that people drive for them for work, that's like an Excel spreadsheet that sort of is comprised of different estimates that aren't necessarily tethered to the realities of their fleet. Because Motus has this unique data, so we know the actual make and model of the vehicles that each of their employees who are driving for work drive. We know what the fuel efficiency is of those vehicles. We know how many miles they drive. We know where and when they drive. And so having all of that data as part of our data set already in the services that we provide to our customers has made it easy to leverage and create a carbon emissions reporting product that allows our clients to be able to have real data, real concrete data about their fleet, and then support them in terms of determining what their plan is going to be over time. Is it sort of low impact, pure benchmarking? Is it, looking at their drivers and who is emitting the most, and which class of cars might they incentivize their drivers to change? Or is it making a true investment in moving their whole fleet to electric? And when I say fleet, I mean the personally owned vehicles of their employees that they drive for work. And so how might they incentivize that? And it's a real opportunity for these companies because it's a place that they can reduce emissions and they can have a concrete plan, whereas some other spaces might be a little bit more amorphous.
This might be a good point to sort of talk about the SEC requirements for companies to report on their various scope emissions. So can you lay out for us what scope 1, scope 2, scope 3 emissions are, and currently what the requirements of the SEC are pertaining to those?
Sure. So scope 1 emissions are direct emissions, direct greenhouse gas emissions from the operations that are owned or controlled by the business. Scope 2 relates more to generation of energy. So you might see scope 2. Once companies do move to electric sources of energy, for example, scope 2 would kick in. That would be right now a bit less relevant for companies that are looking at the emissions of their fleets. And then scope 3 are all of the indirect greenhouse gas emissions that are not otherwise included in scope 1 and 2. And that is defined as upstream and downstream activities that are part of the company's value chain. So there's a lot of discussion around what is scope 1, what is scope 3. Ultimately, under the SEC rules, scope 1 and 2 have to be disclosed, and then scope 3 need only be disclosed if it's material. And so what's been interesting, the SEC rules are in a proposed form right now. They've just received comment letters. So there was a deadline in June for whoever had thoughts and comments on the proposal to submit their comments. And then the SEC will incorporate those, review those comments, and then issue their final rules in the coming months. And so what's sort of interesting about the scope 1 versus scope 3 question is ultimately for companies that are looking at their fleets, I don't know that it makes so much of a difference around what their sort of planning should look like. So the definition of materiality, which is the threshold for scope 3, is a substantial likelihood that the fact, so here the fact, right, is the emissions, would have been viewed by the reasonable investor as having a significantly altered the total mix of information made available. So it's a little bit of a wordy definition. But when you think about materiality and when you think about scope 3, since scope 3 often accounts for the majority of a company's emissions, it's likely that would be of interest to an investor. Certainly companies are gonna sort of decide how they present it, but one would think that over time scope 3 becomes pretty important, even if it has this materiality threshold. And again, it's an opportunity. The way we think about it is, this is an opportunity for companies, regardless of whether they assign it to scope 1 or scope 3. Like I said, brand, employee morale. And then we can talk about one other piece that I haven't covered around, the win-win-win of all of it. But I'll get to that when I kind of finish the scope piece. And so there has been a lot of debate in the U.S. circles about what about this scope 3? Should it be required? Does there need to be a materiality threshold? Many would argue that there shouldn't be that threshold and that everything should be disclosed. But again, I think because investors care, companies should be considering it material. And the truth is, there are a lot of companies that are already collecting and disclosing this information. So it's not going to be such a big lift as maybe some companies are trying to claim.
And I think the crux of that is that we're talking about personally owned vehicles used for business. Do they fit into the scope 3?
So it's interesting. If you look at the protocols, they list scope 1 as your physically owned fleet. So if you have a physical, you own the fleet and your employees drive the business's cars. And then they consider scope 3 business travel and commute. what neither one of those addresses is, what about your work driving, your business mileage? I would, in my view, if you really drill down into how they describe these different things, because of course there's sort of like the high level summary and then there's the different layers and the layers. I think it should rightfully be scope 1, because the business has the benefit and the risk associated with that driving. So they sort of have this economic risk and rewards concept that's baked into this. And, if under US employment law, for example, if you get in a car accident while you're driving for work within the scope of your employment, your employer is going to be responsible for the harm that you cause. So similarly, if you're driving for work and that is part of your job, as I read it, I think scope 1. But ultimately, I'm not sure that it really matters, right? Because companies, if they're disclosing scope 3, that's the whole value chain. And so at some point, someone is going to have to include that in the value chain. So Motus doesn't really take a position as to our clients, as whether they should or shouldn't define it as scope 1 or scope 3. That's kind of within their legal determination, but we provide the data that they would need for either of those allocations.
That's all very interesting. Another take on why personally owned vehicles driven for work are called the grey fleet.
Mm-hmm.
The grey
yes,
area.
exactly. It's the grey zone even here. Yes.
Yeah. We'll be back after a short break for a word from our sponsor, Sofico Services.
Sofico is a world-leading provider of enterprise software for the automotive leasing, finance, and mobility industry. For more than 30 years, international leasing companies and OEMs count on Sofico's expertise and technology to help them transform innovative product concepts into streamlined business processes and engaging customer experiences. With more than 370 experts, 8 offices on 4 continents, and an annual growth averaging 15%, Sofico is perfectly positioned to help its customers succeed in a rapidly changing market where electrification, shared fleets, and multimodal mobility challenge us and our customers to play a pioneering role. Continuous investment in people, innovation, and leading-edge technology is the basis for continued growth and success.
Danielle, this podcast is all about promoting the circular economy with fleets in mind. So I just wondered, if you have any sort of take on how fleets can benefit from the circular economy or help it develop, or how it intersects with, those sort of circular economy principles of reuse, remanufacture, and recycle.
Sure. I think that when you're looking at fleets and when companies are deciding how to manage the part of their work that requires their employees to drive, this really factors into the beginning part of the circle, right? So if you want to have, sort of fewer materials out there and less manufacturing at the beginning of that circle, you would benefit, and the broader environment would benefit from using a reimbursement model as opposed to an owned fleet asset model. Because if you think about that, if every person who drives for work has 2 cars, they have a car that their business bought for them, and then they have the car that they bought for themselves, then you just have a lot more vehicles on the road that you have to find a way to reuse, recycle, etc. So it's sort of getting at the root of the issue by starting with a reimbursement model.
Yeah, fantastic answer. I just wonder, while you're with us, this you call it grey fleet over there too, right?
Yes.
Personally,
Yeah,
yeah. And is that something that's growing?
it is. It's been growing for a long time. We've been in business for, I think, 80 years. But it is growing. There are a couple reasons. So part of it is, of course, what we're talking about. Part of it is employees tend to value choice, and in a growing way with sort of the changes in our workforce. And so being able to choose the car that you drive and have your employee subsidize that while you're working, as opposed to, we've often said, as opposed to someone giving you the beige Impala that you have to drive. So there's that. Another piece from the business perspective is cost and risk. So we saw this, for example, during COVID, where companies were sitting with these physical assets on their financial books, where they are paying for the lease or the payment on these cars, realizing that there really was no reason for that. They may as well move to a reimbursement model, obviously reimburse their drivers for those cars when they're driving them, or whatever is appropriate to the relationship, but without having the risk of maintaining the physical assets. So there are a lot of drivers towards a reimbursement model that we're seeing. And then, like I said, this emissions piece and the circular economy are just another factor in that people are looking at.
I wonder if another stimulus would be the difficulty in acquiring new vehicles now. So it was just something else I wanted to talk to you while I've got you on the line, to ask you about the current scene and what things are impacting on fleets at the moment there. For example, I assume you're having the same difficulties that we in Australia down under are having with long lead times for acquiring new vehicles, inflation, higher prices for used vehicles. What are some of the things that are, crueling fleet management at the moment, and how are they adapting?
Yeah, that's all very real here as well. And so, the way that we think about that is when you're reimbursing your employees for their cars, that rate changes. So when we generate a rate for our clients, though we do provide the data to the IRS for the general safe harbor deduction rate, the rates that we give to our clients, they fluctuate every month. So a driver is going to be reimbursed for a custom reimbursement amount for them based on where they are living geographically, because there are different costs if you're in, Los Angeles versus, a small town in another state. So you need to account for geography, and you need to account for the changing in fuel costs, right? So every month, the reimbursement is going to reflect what fuel prices looked like in that area while the employee was driving. And similarly, if the costs of vehicles are going up, then that's going to be factored in, depreciation, all of these different inputs that we calculate. So it's a pretty complex and robust calculation. And like I said, it's customized and it's real time and it's geographically specific. So that's really important to make sure that employees are kept whole. And I think kind of thinking about the electric vehicle piece and the sustainability and environmental piece, the other piece that is quite interesting for our clients as they think about, moving to a more sustainable fleet is they have the ability through this style of reimbursement to incentivize their employees to move to a more sustainable vehicle. And ultimately, even though they may have some costs up front that we would help them calculate to account for employees who are buying cars that may be more expensive, depending on the electric vehicle. Obviously, that's not always the case. But over time, that we can help them know when the return on that investment comes to fruition, because they're going to have lower costs in fuel and they're going to be reimbursing less for fuel. So there's a bit more flexibility, I'd say, when you look at reimbursement, to help mitigate and help sort of weather the storm of these various challenges that, we're all facing.
I notice in that answer you used the word depreciation, which I know is an accounting term, but I wonder if it should be appreciation, because they're all rising in value.
I know. Yeah, it's a good question.
Danielle, thank you so much for your time today. It was lovely to talk with you, and just fascinating to hear about what's going on in the US.
My pleasure. Really nice to talk with you, and thanks for having me.
That's it. We did it.
We did it. Great.
Yeah, no, that's amazing. Just a story idea I've had for a while is like the death of the company car.
Oh, yeah.
Yeah.
No, I mean, it's interesting because it's funny because when I joined Motus, it was sort of this like mileage reimbursement. This seems kind of boring, but as it turns out, it is so central to so many things and things that have evolved even in just the 5 years since I've been here. I mean, I know, so obviously we're talking about the things that we've just talked about, but then you have the whole gig economy and what is what should people be paid and should they be reimbursed for the cost of their cars and what should that reimbursement be? So yeah, it's funny. We're sort of like this, not necessarily a company that everyone has heard of. We're like the unsexy side of some of these issues, but very central to a lot of them. So it's a pretty fascinating, and it's a really fascinating space.
Yeah, and absolutely the right sort of business at the right time. I mean, with COVID and everybody working from home and, getting all their office gear. Yeah, no, it's all fascinating. And the world of transport is just absolutely amazing.
Yeah, and I agree with you. The death of the company, I don't know why someone would want a company car. I mean, obviously specialty vehicles is a different story. But you need to transport things, etc. But it's interesting.
Yeah. Okay, I'll let you go, Danielle, and have a lovely evening there. And again, thank you so much for your time.
Oh, I guess have a lovely morning. Thank you.
Okay, bye.
All right, great meeting you. Take care. Bye-bye.
You've been listening to Fleet Auto News Podcast. It was edited and produced by Isabella Fiorentino. Thank you again to our new sponsor, Sofico Services. It's great to have you on board. The original theme music for this podcast was created by Isabella Fiorentino. You can follow us on Spotify. Just search for Fleet Auto News. We're also on Instagram, Facebook and YouTube. Our website is fleetautonews.com, where you can get all our stories, videos and podcasts. Until next time, drive safely and take care.